All right, so what's up, everyone? Welcome to today. This is Tuesday, February 18th of 2020, and today I'm going to cover the third part of our series. And today's focus is institutional swing points, and I'm going to make this quick. I'm going to make this direct, and so we can get to more topics as regards to institutional trading. All right, so let me quickly remove this, and we're good to go. Now, um, as regards to institutional trading, I know there's lots of reversal patterns out there on PDFs, trading PDFs, and you know, free tutorials on YouTube, and different mentors out there with different types of reversal patterns in Forex. But as regards to institutional trading, when we're defining market turning points via from an institutional standpoint, okay, it's basically only two ways the market reverses from a level. Okay, so as regards to institutional trading, we have the breaker. This is what you see here for the sell side, the buy, sell reversal, and then the buy reversal. This is the breaker, and then we have the failure swing. And in a couple minutes, I'm going to show you guys how very vital it is that you add this to your repertoire as regards to trading and to your knowledge base as an institutional trader, because this what we're going to cover today is going to be mind-boggling. It's going to blow your minds. Okay, so now let's get down to this. So we, as regards to institutional swing points, we have the breaker and then we have the failure swing. So what I'm going to do is I'm going to cover each section and explain in details what they entail, how fund funds liquidity gets trapped, and via the breaker, and also via the failure swing in the marketplace. Okay, so now as regards to the breaker, there's obviously the market turning point for a sell, and also which you can see here, like this. Then there's also the market turning point for a buy, which is what you're seeing here. The main key you want to note is before you see the market make a turning point from a level, it is going to do that based off on higher time frame level. Okay, so make sure you write that down on your notepad. Okay, so the market never makes a major market turning point from a smaller time frame level. It's usually off a weekly level, a monthly level, a daily level, or minimum of a 4-hour level. So make sure you have that down on your notes. So if you're looking for market moves away from a level and you want to confirm if the market has actually made a turning point of that level, what you can actually do is to look at the time frame where the market made a reversal from. And then if you see an institutional reference point on one of these higher time frames, then there's an higher chance that the market has made a turning point from that level. Okay, so I just want to put that out there. Now let's get down to the breaker. So how does the breaker form, and how can you ride the coattails of the central bank moves? Okay, so now if you refer back to previous videos, the first video covering IPDA ranges, right? I mentioned that what IPDA basically does is to move price around to points of efficiency or liquidity where the floor traders of the central banks can then capitalize on those moves. Okay, so either you're aggressively selling or repricing or buying, right? All right, so now as price starts to approach an higher time frame resistance level, right, IPDA starts to move price towards that level. So price keeps driving higher, higher, higher. Now, if you also refer back to the last two videos, I mentioned that in nature, the fund traders are trend-based traders. So they like to follow the big moves, right? They like to ride the trend. So where they fail miserably in the strategy is at market turning points. Because in nature, the fund traders are trend following in nature. Okay. Right. So All right, so sorry for the break, guys. All right, so now let's get on to this. Um, as IPD starts to drive price toward higher time frame resistance level, then you're gonna see higher highs, higher lows, higher swing points, basically. Now, as price starts to get towards the higher time frame resistance level, right? You're going to see price try to reach for that level, but fail to really get to that level. So this is where most retail traders fail. Okay, retail mindset, sorry. Yeah, retail traders, because we're all retail traders basically. And this is where institutional retail traders fail in your analysis because price does not really tap that level and makes a failure swing, right? So price makes a failure swing away from that level. And then people think the market has turned around from that level because support resistance is a zone and not a price point, okay, not a line, right? This is what we're taught. So people look at this as a swing guy and that the market has been a turning point from that level. Then what happens? There's aggressive shorting from the retail traders. Okay, so retail mindset traders are shorting. And now, if you also refer back to what I talked about, fund traders, people manage hedge funds, who manage large amount of liquidity. These were once retail mindset traders who got good at your craft and then were able to get that promotion to be fund traders. So in nature, the fund traders are all retail mindset traders also. Okay, so now what is then going to happen is price will make a failure swing, get into this resistance, and it would start to look like price wants to go down. Okay, price is going to start to trade to the downside, and everyone thinks, okay, this is a swing guy. Price is respecting this higher time frame level, and it's time for price to just drop down. Okay, then people will feel the opportunity to short around this level, start to short from this level. Okay, so they start to short from this level, they're shorting from this level, shorting from this level, and then all of a sudden the market rallies into the higher time frame level, right? Effectively taking out all the buy side liquidity above the marketplace. So all the sellers inside this failure swing get trapped, right? So this is done on purpose, just to what the central banks are basically doing is, or what IPDA is basically doing is, as IPDA starts to approach this level, IPDA starts to reprice lower, right? And then the market starts to trade down. And people look at this as the market wants to go down. And then they start to add positions into this. Okay, so you're shorting, you're selling. And obviously, if you're selling, the stop loss goes above the swing guy, right? Then all of a sudden, the market rallies higher because what the central bank floor traders would then do is they know ahead of time where price is trying to reach for. So once there's liquidity, once you're able to get enough liquidity above this failure swing, they would then pair up the buy stop orders with your sell limit orders. Okay, so the market would have to automatically trade up to that level to pair up those orders and then get that explosive move to the downside. So what the central bank floor traders basically did was to do a business deal by profiting off the liquidity around this failure swing. So the failure swing is the key element providing that liquidity for the floor traders of the central banks to capitalize on this sell moves. Now, this is why it's essential that you understand the first video I was talking about. So I said IPD is going to drive price to areas of inefficiency and areas of liquidity in the marketplace, right? Now, IPD is driving price to this level. IPD knows when it gets to this level where there's probably inefficiency, okay, in form of an higher time frame resistance, as you can see, be it an order block, a fair value gap, or mitigation block, okay? So this is where price is at a premium where it is going to be favorable for the central banks to aggressively short the market from this level. So this failure swing basically is the catalyst for this sell move, right? Because like I explained, there's money to be made by trading against the hedge funds to the central banks. Okay, there's money to be made by trading against the hedge funds to the central banks. So the central banks, whilst they create the environment for other players to speculate in, They also make this little sneaky moves to make small profit off this hedge fund players by doing this kind of thing. So now, if you look at all time frame, you're basically gonna get one of these two swing points, be it a breaker or a failure swing. Okay, so I'm going to get down to what a failure swing basically is. So what the breaker basically is doing is creating that liquidity for IPDA to drive price into. And also, if you refer back to the first video, I said IPDA is going to drive price to the level, and then the floor traders who know ahead of time what IPDA is going to do will then capitalize on those moves. So what the floor traders of the central banks are doing is capitalizing on this move where IPD drive price into this liquidity, and then they reprice aggressively lower, and then price shifts to the downside. In that way, they get the best premium level. Okay, and then this move up then becomes either your mitigation block or your bullish order block. Okay, so this is where we then get down to how can we as institutional traders anticipate this kinds of move. Okay, so this diagram you're seeing here is simply a bearish breaker, okay, in the marketplace. And this is where we go into a step-by-step approach on how to identify a breakout forming. Okay, so get your notepad, guys, and make sure you get this down. Step-by-step approach to identifying a breakout before it happens in the marketplace. Okay, so now the first thing you want to do is to have your higher time frame resistance level or support level in place. So you want to know where price is reaching for. And if you have questions with that, I want you to refer back to the first video covering IPDA ranges, where I mentioned institutional reference points where price is going to most likely want to reach for. So refer to that video, probably give it a watch again, and then come back to this video so you can understand what I'm saying about institutional swing points. All right, so the first thing you need to have down on your charts is the higher time frame level where IPD is going to try to drive price into, and where we could see a pricing around that level. Okay, that's the first thing you want to do. Okay, so now as the market starts to trade to that level, watch how the market acts around that level. What you want to see the market do is you want to see the market trade into that level and not just fall short of that level. Okay, so you want to see the market trade into that price point. Okay, the specific price point. You want to see the market trade into that level, either tap that level perfectly or trade into that level by a very small margin before it makes that move lower. So now you then become suspicious if the market approaches that level but misses that level and starts to trade to the downside. That is something suspicious, especially if you're around old highs, old lows. And this is basically how sub setups form in the marketplace. Okay, when you have equal highs and the market wants to make a turning point around those equal highs, the market will make a false failure swing or a false swing, right? Then quickly drive into that price point and then reverse all the way down. Okay, so the market trades to that key level or falls short of that key level, okay, but fails to immediately react or makes a small reaction of that level, showing signs that it wants to trade to the downside. And then you can then begin to anticipate that this could be a potential breaker forming the marketplace, because what you want to see is price trade into your higher time frame level precisely, or trade a bit deeper into that level. Okay, so once you start to see price fall short of this level, you know you've got a breaker in your hands, and what you're actually doing is you're in line with what the central bank floor traders are doing. You're pairing your sell orders with that of the buy stop losses of the neophyte traders who are actually selling this failure swing. But then what you're then going to see is price will drive up via a mitigation block and break to the downside. Okay, so now you have your first entry around this level, okay, as your first entry one, and then you can have a second entry. Once price breaks to the downside, you can then look for a retest, because the institutions bought up the market to pair up liquidity around this level. So you're going to look to mitigate the buy positions and hold the short sell positions. So they will drive price back up to this level to pair up the buys with the sells and close out your buy positions at break even so that they can then be net short. So once you start to see price retrace back to this level where price took out this failure swing, then this is your opportunity to sell short again for a re-entry or entry number 2, if you want to call that. So this is the way you can approach trading the breakout when price makes that false swing or price falls short of that higher time frame level. Then you know you have a breakout on your hands and you can begin to anticipate that. So this then becomes your mitigation block. Okay, and then you can look for prices either from your entry one around this level when you're doing what the central bank floor traders are doing, and then you can do this also as price drives back into this old low where the central banks bought up the market. The central banks are going to look to mitigate your buy positions around this level, and then you can look to short around that level. That way, you're doing what the central banks are doing. Okay, guys. So this is how you can ride the coattails of the central bank trading the breaker pattern. And the same thing also goes for the buy scenario also. Price approaches your higher time frame support level, be it a daily, monthly, weekly, 4-hourly, order block, fair value gap, negation block, okay? Price approaches that level, but falls short of that level. That is going to create liquidity below that swing low. Then prices drive down into that level. You can then look to buy around that level, expecting higher prices. And one more thing I want you to know, guys. Once price gets to that level, it's something clear that you know you're correct and price will not just trade through that level. Is you want to see price quickly trade away from that level. Okay, you don't want to see price hold around that level for too long or consolidate around that level for too long. But if price begins to consolidate around that level for too long, then most likely it could be a continuation pattern and price could just break to the upside. So you want to see a quick reaction of that level, okay? Because the central banks are going to look to quickly reprice the market lower away from that level. Because what price is simply doing is price is jumping up to pair up sell side orders with buy side orders with sell side orders on central banks, which will then shift the market down. So you're looking for that quick reaction of that level. So let's say, for example, now as you all know, with this kind of swing point, it happens on all time frames, right? So if it's kind of set up on a monthly time frame, obviously you could take about a few months for this to unfold, right? Whereby the market uses a monthly candle trade up into this level, then you can look at the next monthly candle dropping down into this level. But if price has to consolidate around that level for 2-3 months or 2-3 monthly candle, then you know most likely it could be a break. You could expect a breakout because you don't want to see price pause around or consolidate for long around that level. So if you're looking at the consolidation and you want to estimate the time, period the time period you want to attribute to that consolidation to know if it's a breakout could be on the books or you're still looking for a reversal. Look at the time frame you're looking at that breaker. Okay, so the time frame is going to give you clues. So basically, if you're seeing a break on the 1 hour time frame, you don't want to see price pause around that level for more than 2, 3, 4 hours. You want to see a quick reaction of that level and then a break lower. So the same thing applies for the buy side. So that, guys, is the anatomy of the breakout pattern in the marketplace as regards to institutional trading. Now, the second market reversal pattern in the marketplace is the failure swing. Okay, so now one thing about the breaker is the best setup you can get because the breaker gives you the most premium market and the most discount market. Because if you're actually able to get a move in line with the breaker at the top, you're actually getting that move where the central banks add your orders at. Okay, so that means you're getting the market at the most premium price possible, at the most discounted price possible. That's where you're getting your trade. So the breaker offers the most premium price and the most discounted price because this is where the market makes its original turning point. Okay, so now let's go down to the failure swing. So now, what is the failure swing? Okay. So all right. So a failure swing, as always, you want to have your higher time frame resistance level, higher time frame support level identified beforehand, and you're looking at how price reacts around that level. Okay, so now the typical characteristic of the failure swing is price is going to blow past that level. So it's going to look like price is breaking out of that resistance level. So it's going to look like a breakout pattern, but then price breaks out of that level, but quickly pulls down below that level. Okay, once you see that, that becomes a possible failure swing. And the reason why failure swing occurs in the marketplace is, as you all know, I mentioned the fund traders are trend-based following, and the system they like to trade is the 20-day IPDA breakout system, whereby if price breaks out past an old high, an old low, okay, there's going to be pending buy stop orders by institutions around that level, and you're looking to ride the prior move, okay, of the marketplace. So now, what is actually going to happen is around this higher time frame resistance level is going to be pending by stop orders resting around this level by the institutions and also by the collective herd of the retail mindset traders. So that creates liquidity for the central banks to reprice the market to the downside. Now, you know, the business basically in the market is a competition between the central banks and the um, the fund level liquidity and the collective herd of the retail traders. Okay, so what price is actually doing is price is looking to pair up orders in the marketplace. So for price to move up to the upside, someone needs to offer a sell side for the buy side to for price to be priced higher. Someone needs to sell to the next person for the next person to buy. Okay, basically. So for the market to make turning point, it needs that liquidity to make that turning point. Okay, so market cannot just get to a level and then just make a turning point of that level. Someone needs to be offering the buy side and someone needs to be offering the sell side. So if the central banks are looking to make a turning point as regards to an institutional standpoint, they're going to look to, if they're looking to make a sell side turning point, you're going to look for a liquidity pool to reprice the market lower of that level. So this, guys, is a very, very deep concept. Okay, this basically is the anatomy of the market. For price to be repriced to the downside, there needs to be buy side liquidity being offered for price to be repriced to the downside. Okay, so IPD is then going to drive price into where a collective pool of liquidity is resting. Then the floor traders of the central banks will then reprice lower by pairing up the buy side liquidity with just sell orders, which will then shift price to the downside. So a failure swing basically looks like a breakout system. It's a total kind of setup, okay, whereby price looks like it's breaking out of the higher time frame level, but price quickly pulls down below. So now the question is, how do you get your entry around this level, right? So you wait for price to retest that level. Once price retests that level, there's a setup, there's a sell setup, okay? Now, the price might not give you as premium price point, might not offer as premium price point as the breakout pattern, but this is also a very high probability setup in the marketplace. This is a premium price setup where you can sell in line with what the central bank floor traders are also doing. And the same also applies for the buy side market, buy side turning point market. Okay, so now let's give a step-by-step approach to trading the failure swing. So if you have your notepad again, bring out your pens, bring out your notes, and let's get down to this. All right, so first off, you want to have your highest time frame support level or resistance level down on your chart. You want to be monitoring that level, your institutional reference point for IPDA to drive price to that level. That is your step one. Step two, as price starts to drive to that level, you want to see how price reacts to that level. Is price making a failure swing around that level, which could signal a potential breakout scenario, or did price trade through that level, which could be a potential failure swing? Now, if price trades through that level, which is your step 3, you're looking for price to quickly pull down below that level. So the act of price quickly making that corrective move to the downside after the break, the break to the upside, signals the buy side liquidity being trapped around this level. So you want to see that quick reaction of that level. You want to see price trade into that level and quickly react off that level. That is a signal that liquidity is being trapped around that level. Then your step 4 is the retracement back to the higher time frame level, which is where you're looking to have your positions for premium market for sales and discounted market for buys. Okay, and then once you're selling, your stop loss then goes back to the original swing point. Okay, that is where your stop loss goes if you're selling this premium market, and if you're buying this discounted market, the stop loss go to the original turning point in the marketplace. So what that simply means is if you're selling from this level, this is where you want to sell, guys. So if you're selling the retracement back to the higher time frame level, the stop loss goes here, and if you're buying the retracement back to higher time frame level, your stop loss goes around this level. And that way, you do not expect the market to go back to this level, because if the market goes back to that level, it would offset the trap liquidity around this level. So the market is going to make a quick reaction of that level, and you see the explosive move. All right, guys, let's get down to the final segment of this video covering institutional swing point. And what I'm going to be addressing is the price anatomy of how central banks offset fund liquidity at resistance points. So this video basically is covering resistance points, and you can simply just invert that to get support points. Okay, so now phase 1, you're going to see the market trading. The IPD is going to start to drive price to institutional reference points in form of sell side, be it a bearish order block, bearish fair value gap, bearish rejection block, a bearish breaker, a bearish negation block, or an old high. Okay, so IPD is going to start to drive price to that level. You're going to see higher swing points. And what's going to happen is as price starts to trade higher, the funds are going to have pending buy stop orders resting around higher time frame resistance level. The funds are expecting a breakout of that level for price to continue the underlying trend, which is the bullish trend. Okay, so because like I explained, the funds trade a 20-day IPDA breakout system. So you're looking for that breakout for a continuation move, right? Now the phase 2 is IPDA is going to quickly drive price into that level, and price is going to break through that level, which will look like a breakout, and price wants to keep going to the upside. Okay, that way price activates institutional buy side liquidity. And what is then going to happen is the central banks are going to pair up the sell side orders with institutional buy side liquidity, and price will then quickly reprice lower to the downside. Okay, so now your phase 3 is the fund level buy side liquidity is now trapped because the market is now trading below where your orders are. And then you can look for a symmetrical price move. So I want you to write this down in your notes. Symmetrical price move often occurs at market turning points. Okay, and you're gonna see live examples quickly very soon. Okay, so I'm gonna give you one example, and then you can do your assignments on this. So fund level liquidity is now trapped, and then the market would seek to make a measured move. So measured move meaning the distance from A to B would be the distance from C to D, which is your symmetrical price swing. So price is going to trap fund level liquidity, trade to the downside. Price is going to trade back up to mitigate central bank buy positions that central bank mitigation blocks. Okay, so probably they bought the market around this level, or they're moving price back up to a premium level again to reprice the market lower. So the market is definitely going to make a retracement then the central banks will then reprice the market aggressively lower, making a measured move. The same distance from A to B will be the same distance from C to D, and that could be your swing trade target objectives. Okay, so this is very good for swing trading objectives. Okay, price is going to make a symmetrical price swing, and then your phase 4, the fund buy positions are now in net loss because the market is trading lower than where the funds bought the market. And then what the funds will then do is to mitigate your losses on this buy position, they will look to ride the sell move, okay, around this level. So the funds will then sell the market around this level at a discounted price, okay, to offset the losses on the buy side. Okay, so what the central bank basically did was the central banks got the sell moves at the most premium price point, and then they offered a discounted price to the fund liquidity or the fund traders to then sell this move. Meanwhile, during drawdown, they're looking to mitigate these positions around this level, so they have to sell. So that way, if they're in profit on the sell, okay, the losses on this buy is being mitigated by the profits on the sell. So that way, the funds are getting the sell positions at the worst possible point, whilst the central banks already positioned themselves for this move. So, all right, guys, let's go to a live example of a market turning point. Currently, this is US oil, the 4-hour time frame, and we're floating about 161. Sorry, I think about let's see, this floating currently about 120 pips on US oil. And I'm going to show you how I basically applied this in trading US oil using the breaker pattern to trade, the failure swing in trading oil. So let's go to the weekly time frame, guys. All right, so if you look at the weekly time frame, looking at our institutional reference point, you can see that just very clean equal lows around this level, and just also a down candle, which is our weekly order block. So this is our weekly order block, and price has seemed to respect that weekly order block in the past, and price basically has traded back into a weekly order block. And what price basically did was, this is still a valid order block, weekly order block we can use, but there was equal lows around that level, and there was a lot of room for price to expand to the upside, as there's still this bearish order block, there's a fair value gap, there's pricing efficiency all to the upside. So price needs to somewhat fill up this pricing efficiency, which is what I said IPD is going to do before we could see price potentially drive to the downside lower, or price just continue to blow past this equal as to the upside. So the way I viewed this market was equal lows around this level, institutional reference points. One of them is the equal lows. Okay, so IPDA was driving price to this liquidity because funds are going to have pending sell stop orders below this clean lows, expecting price to continue this move to the downside, reaching for this level. And if you expect that, then what price basically did was price drove down into this level, okay, activating all sell stop orders below the marketplace at that level. And then price, this is why I said you wanted to see you want to see a quick reaction of that level. So as price drove down into that level, quick reaction, a retracement back down, quick reaction of that level. So that validates failure swing. This is a bullish failure swing. If we go back to what I just taught you guys, you want to see price drive down to the higher time frame level, make quickly react of that level, retrace back down to the level, and then rally up, which is what you're seeing on oil. Price drops down to the level, okay, makes a quick reaction of that level, retrace back down into that level, and this is where we had our orders for the buy side on oil. So this basically was a turtle soup, which is what I said. Failure swings are very common for turtle soup patterns. So if you break this down to the 4-hourly time frame, you can see a more cleaner price action on the 4-hour time frame. So we know this line is a higher time frame weekly liquidity pool, where price could seek to reach for. So look how price was quickly driving down into this level. So what was moving price down to this level? IPDA. They wanted to get the liquidity at this level. So you can see how there was a lot of room for price to fill up. There was price inefficiency in this candle, price inefficiency in this candle, liquidity void in this range. Okay, so price was driving aggressively down to the downside to activate all the sets of orders. So now what the central banks actually did was to simply pair up their buy limits with the fund level sell stop orders. Okay, and then as price drove down to this level, you can see a quick reaction of that level. Okay, so look how prior to the market trading to the downside, there's basically no higher highs. There's all lower highs, lower lows, lower highs, lower lows, until we got down into this level, higher high, as price traded into this higher time frame level. With a higher high, price came back, we tested this level, and price shot up to the upside. Okay, and now price came back to the downside. We tested this level, which is a daily order block in line with a weekly order block, and we had an entry around that level from using the failure swing, which is what I said. You want to see price retrace back down to that level. Look how clean price reacted of that level. Okay, basically no drawdown, clean reaction of that level. Currently, we have stops at break even, taking first profits of the trade, and now price is looking to trade up into this upside. So now, the reason why I gave the swing trade as this next level is because I said around market turning points, you're going to look at a symmetrical price swing playing out in this market. Okay, and if you measure the market from this low to this high, okay, let me change the cursor to the cross. So if you measure the market from this low to this high, okay, at this retracement, if you move this line to this level, that gives you your symmetrical price swing to 53.95, basically 54, okay, which is a significant move, about 300 pip move on oil. So guys, that brings us to the end of this video. Hope you all value the concepts being dropped in this video. I will look to drop more concepts, and very soon I'm working my way into PDRAs. We still got a lot to cover in terms of seasonal tendencies, using intermarket analysis, using the yield triad, which is interest rates, yields, and treasury notes, before we get to PD arrays. So guys, that is all for this session. See you guys all next time, and have a wonderful trading.